Hello, everyone, and welcome to today's daily analysis. Today is the 6th June 2024. The US dollar index extended gains on Wednesday despite mixed signals from the US economy. The strong performance on the services sector, coupled with lower than expected private sector employment data, causes mild market volatility. However, the overall outlook for the US economy remains resilient. On Tuesday, the US dollar index rose slightly despite weak labor market data released by the US Bureau of Labor Stats. The previously bearish market environment seems to have stabilized, driven by weak May PMI data from the Institute of ISM. They said the Fed Reserve to cut interest rates more quickly. Market attention has now turned onto other labor market data, including non-farm payrolls, wage inflation, and May unemployment data, which will provide more insights into the US economy. Despite the small gains from Wednesday, the outlook remains pessimistic. Technical indicators such as the 14-day RSI and moving MACD remain in negative territory, reflecting persistent bearish sentiment and the sudden pressure from short-term. The daily chart shows that the overall trends have turned into favor of the bears after breaking below the 20-day 104.70, 100-day at 104.41, and 50-day at 105.07. Simple moving averages. Once it breaks below 103.99, which is yesterday lows, and 103.93, 61.8% Fibonacci retracement of 102.35 to 106.51. It will challenge 103.75 at 300-day SMA and 103.33, 76.4 Fibonacci retracement. On the other hand, if the US dollar index recrosses above 104.43, there will be a chance to rise back to the short-term key resistance areas of 104.92, 38.2% Fibonacci retracement. The 104.98 55-day moving average and 105, which is market cyclical level. Next, for the WTI crude oil, it roses on Wednesday as the market energy tried to shake off the impact of another increase in the US crude oil inventories. The Organization of Petroleum Exporting Countries and its non-member allies warned this week that the global oil cartel will gradually cancel voluntary production cuts as the crude oil producers become frustrated with OPEC's inability to make plans. The market support for barrel prices. WTI crude oil fell to a new low on Tuesday as an energy market sentiment extended the retreat in risk appetite. The OPEC and its extended network of non-member countries, OPEC Plus, recently announced plans to gradually roll back voluntary production cuts aimed at boosting global crude oil prices. As the global crude oil demand growth has failed to materialize as many investors expected, the bids per barrel are falling as few traders see a reason to buy long crude oil as global supply will exceed demand data. The crude oil traders will focus on weekly US supply data provided by the American Petroleum Institute and EIA, Energy Information Administration. The most recent weekly crude oil inventory report showed a sharp drop in the number of raw barrels in US storage facilities. Technicals on the daily chart suggest a strong bearish bias as the latest leg of the larger decline from 87.08, which is 2024 high recorded on April 5, has so far retraced to 72.45. However, the recent sharp bearishness, oil prices have fallen more than 9% in the past 5 days should be expected, and oversold conditions may prompt some profit taking by the bears. Bears have fought solid support at 72.51, 1017 lows, 72.45, which is 76.4% retracement, and $71.42. With the resistance expected to increase at all three levels, in the current situation, the scope for correction may be limited, such as once the upward breakthrough of 74.14 Monday low, and 61.8% retracement of 75.25 provide good resistance. It may return to $77.51, 50% Fibonacci retracement. For the gold price today, the gold price struggled to maintain bullish momentum, trading around 2,354 after hitting 2,357 earlier in the session on Wednesday. The gold prices were once under selling pressure on Tuesday, falling to the 2,316 to 2,315 area, falling to near the multi-week lows hit after the dollar strengthened slightly the day before. However, the dollar tried to rebound from the more than 2-month low due to the growing belief that the Federal Reserve will start cutting interest rates later this year, coupled with weak U.S. macro data. This expectation weighed on the U.S. Treasury yields, which in turn boosted zero-yielding asset gold prices. In addition, the geopolitical risk caused by the ongoing conflict in the Middle East further boosted safe haven gold prices above $2,330 in Asian trading on Wednesday. Despite a series of supporting factors, the gold prices still struggle to attract obvious buyers as investors prefer to wait for the release of key U.S. employment monthly data or the non-farm payrolls report on Friday. From a technical perspective, the gold prices currently seem to have found support below the 25-day simple moving average of $2,250. In addition, oscillators on the daily chart have just begun to gain bearish momentum, supporting the prospect of further declines. A subsequent break below the multi-week lows hit on Tuesday, around 2,315 to 2,314, would reaffirm the bearish bias and push the price below 2,300, which is the psychological barrier, and 2,298, which is 50% Fibonacci retracement of 2,146 to 2,450 levels, leading to a test of the horizon support of 2,277.3. Some follow-through selling would serve as a new trigger for bearish traders and pave the way for continuation of the consolidation decline seen over the past 2 weeks or so. On the other hand, any clear upside move in the price of gold now seems to be met with strong resistance around 2,350 supply zone. The next relevant resistance is around 2,360 to 2,364, and a clear breakup of this level would see the price climb further to the intermediate resistance of 2,385, leading to a breakout of 2,400 mark. And that is all for today's daily analysis. If you are interested in trading or have any questions, feel free to reach out to our channel. I'd be happy to answer. Thank you.